Welcome to Fin Street. We have with us Mr. Himanshu Yadav, tracking bond markets for a long time now, around 15 years. So today's focus is on the AT-1 bond issue that has come in for Credit Suisse and what that has an impact on Indian markets. Himanshu will guide us. So Himanshu, what is your view on AT-1 bonds in India? How is the market placed for them in India?
In terms of spreads, we are trading pretty narrow in terms of the spread basis. When they were first introduced in India, the spread used to be more than 100 basis points compared to the senior bonds. Later on, with the demand or with more participants interested in it, it got narrowed down. Then after this Yes Bank fiasco, again they were widened pretty much. uh, but considering the inherent risk in it, they should not be trading at the current spread of 100 basis also. Should be pretty much more than the risk premium that we charge for equities compared to bonds. So ideally, the spread should widen in India also. If you compare the spreads in Europe, the spreads in India are pretty less.
Okay, so who are the participants in AT-1 bonds? Is it a liquidated market? Like, does it have sufficient liquidity in the system?
So initially, it was a pretty liquid market. It started with the participation of the mutual funds and HNIs in it. Then later on, the regulatory and the valuation issues, and then the whatever we all know whatever happened in Yes Bank. Then slowly the participants started moving out of it. So initially, the mutual funds were there, the insurers were there. They have moved out of it. Not only some HNIs and the banks are the major participants in it, who are normally do subscribe in the primary issuances. Other than that, some corporates are also there. But overall, the market has gone too illiquid actually, and that has asked for maybe the spread can be the one of the reason for it. So ideally, the spread has widened. Once the spread widens, and that justifies the inherent risk in these bonds, maybe more participants we can see in coming future. But right now, it is very illiquid.
So one of the category you mentioned is that the retail moved out. So to talk about participants, that is retail investors, can you guide retail investors as to how and where can they participate in Indian bond market?
So earlier, the retail or the HNIs could participate through brokers or through wealth managers. So they used to take these bonds in their own books and then used to distribute it to the retail investors. Then way to participate was through investing in the listed bonds through NSE or BSE. But recently, RBI has introduced the RBI Direct, where the participants can invest in government securities, state loans, or the T-bills without having any demand. So the say face value requirement or the ticket size is also low. So it is a very good introduction by the RBI. So it is one more option given to the retail investors to invest in the bond market. Otherwise, they had to first create the DMAT. So DMAT was compulsory when it comes to the industry.
Okay. So, Mr. Himanshu, do you suggest a checklist for retail investors as to, what they should look for while investing in bond markets? How do you trust bond issuers and the facilitators?
Frankly, so the first factor is, of course, the rating. They should go through the rating of the bond, go through the rationale provided by them. And other than that, of course, the basic of any bond or a company, how to study the financial is must for them. Then the corporate governance is one of the foremost thing that we have learned from the LNFS, DHFL, or the Yes Bank fiasco. The corporate governance is the most thing, and they should go through the IAMs for in detail whatever is written in the covenants of the information memorandum of any issuer. So these are the major checklists actually. The point is that they should not only rely on the rating of the bond; they should have their own due diligence.
Well, in capital market, bond market forms a majority part of the overall market, somewhere around more than 80% or 90% kind of a range. So, is that, a threshold in terms of what kind of returns should retail participants do expect from bond market, let's say, over a time frame of 1 year?
So as you would be aware of right now, all the fixed income instruments, you talk of FD, any money market instrument, GSEC, T-bills, or any mutual fund scheme, everything, any bond is trading above 7%. So right now we are at the faggot of the any peaking. We can say that the more or less the rates have peaked out. But I still believe over the next 6 to 1 year period, 6 months to 1 year period, rates are going to stay at around current level only. So they have good range of time to gather the money and invest at such high returns, more than 7% return. And the point now is whether they want to invest in duration or not. So for that, I will suggest first they should know, since duration is a typical concept, they should first know in-depth knowledge about the duration, how the duration works in terms of when it comes to the bonds. And other thing is they should be aware of their liabilities. So duration and liabilities
Okay.
are uh, uh, means they should be aware of when their liabilities are when they want their money back. So accordingly, they should be investing in the market. Otherwise, this is a good time to invest in a bond market.
Okay, that's a word coming in from Mr. Himanshu Yadav with his views on AT-1 bonds in India and how retail participants can participate in Indian bond market. Thank you so much, Mr. Himanshu Yadav.